Hey, what's going on, guys? It's your man Sadiq. Welcome to Experiences with Sadiq Live. Today, we're actually going to talk to Doug Iannuccilli. He's with Envoy Mortgage. Doug is when it comes to mortgages and what's going on in the industry, Doug has that insight. And right now, there's a lot of things that's going on, and people need to get a clear understanding of what's actually going on in the industry.
Thanks so much, Sadiq. I appreciate you having me on. Pleasure to be speaking with you and always working with you as well. Thank you for that great introduction. I really appreciate it. What we want to touch upon, as we previously spoke, is something that is affecting the mortgage industry. Obviously, there's a pandemic, a virus. We certainly hope everybody is safe and well and doing their best to social distance. And we wish everybody's family, friends, loved ones, obviously, to be safe. With that being said, there's a lot of things that are happening, affecting borrowers, affecting lenders, things of that nature. And we're really going to hone in on basically a discussion on what's called DTI, a debt to income ratio. That's what it stands for. Ironically enough, it also happens to be my initials, DTI. So I guess I'm a dual expert perhaps in that field. With all that being said, here's what's really going on. The mortgage industry, it's a little bit in a crisis. It's very much like the crisis, as a pandemic, and people don't really understand or see that. Rates are low. They're still very good. They're a little bit away from that all-time low that occurred. But what's happening is, and this is why the DTI is a major concern, employment and income and how that's calculated. What's happening is with the threat of job loss or being laid off, people are perhaps going to have or take the opportunity to do mortgage forgiveness, mortgage forbearance. They got to read fine print. They got to see what this looks like. But basically what that means is, hey, I might be in a position as a consumer, I can't pay my mortgage payment unbeknownst to me. I was fine before. My job situation, I don't know what's going to happen. Maybe I've already been told I'm laid off until a later date. But what's happening with that, and the government has come in and incentivized the housing agencies to say, listen, we want to have relief for some borrowers. With that being said, the scare to the mortgage industry with the end investors, the servicers, and the lenders themselves is they may be writing new mortgages, brand new mortgages as of last month, this month, today, tomorrow, and we may have mortgages that people won't be making payments on. So that drives rates to go up because there's more risk inherently involved with it. It's going to have lenders tighten their guidelines, either willingly or mandated by the agencies that they deal with. And depending on their warehouse lines and getting into that as well, they may see further constraints. So what's happening is debt to income ratio on certain type of loan programs, my company included, have made some restrictions against these higher debt to income ratio files. So as an example, I'll speak on FHA really quickly, but this is across the board for government mortgages, which will be considered FHA, USDA, and VA. USDA offers 100% financing. VA does as well. FHA allows 3.5% down, so very minimum down. And there are some grants and other down payment assistance programs potentially to get people to that 100% financing, but even that will be restricted. Underwriters are doing a better job or a more thorough job, not that they weren't before, but they're impressed upon from every organization to really make sure the client is stable as far as their income, their employment is concerned. They're restricting debt to income ratios. So as an example, FHA allowed a back end debt to income ratio to go as high as 56.9%. It still has to meet other qualifications, but that was a maximum debt ratio. Now, put that in perspective here. When I give this number of 56.9%, we're talking about gross income figures, not your gross income before taxes are taken out, anything. So let's just say you make $60,000 a year, just as an example. That's $5K a month gross. You can go as high as 56.9% under normal traditional circumstances with your mortgage and all your other bills off that $5K. I'm going to do a quick calculation just to give you an example. 56.9% of $5,000 means you can carry enough debt load to not exceed $2,845. And previously, we were granting approvals on that. Again, other qualifications, credit score, and certain things still apply. But with all that being said, we're allowing gross income. We're basically saying over half your income can go towards your bills and housing expense. altogether off your gross income before taxes are taken out or anything. That's a super high number. And when we say other bills, we're only referencing what shows up on a credit report or court-ordered child support or things of that nature. What we're not talking about or factoring into that number are utility bills, your car insurance. You may have other expenses that aren't listed, aren't shown up. We as consumers know that they exist, but it's not part of the mortgage calculation. So in a prime environment with no economic concerns, these constraints will be lifted at some point, but you can see how aggressive off gross income, we're basically saying, or the government is saying with these backed mortgages, hey, it's allowable to go up to these figures at a maximum level and still give someone a mortgage.
In regards to what's going on now, there's a lot of buyers that's actually, the mortgage company are actually pulling away, right, from borrowing loans to individual buyers. What's the actual underlying purpose for these mortgage companies to actually go towards that route?
Okay, so what's happening in general, and it's hard to say if it's going to go away or not, a lot is going to be dependent on what happens in the United States, certainly with, COVID-19 and how long this is going to go. Are we going to see some relief? Because there's a lot of fear and uncertainty. So the government certainly has done a good job with protecting consumers, but in the lending side of things, it's going to get scrutinized, and our company has made some changes. A lot of companies have, a few haven't. We feel that they will in relatively short order. If they don't, that's on them. They may have unsaleable loans, which affects the industry, affects their bottom line, and may affect their livelihood of actually staying open, believe it or not. With that being said, Envoy as an example, and it's been communicated through all the branches. So there's been the transparency has been great. There's been no sticker shock as far as, hey, I didn't know this was happening. If you had your file submitted, locked, registered within our company prior to the rollout of this, anything's fine, even if it didn't meet the new restrictions. So some new restrictions for Envoy anyway, just as an example, we've raised our minimum credit score to a 640 for FHA, whereas before it could be as low as a 580. So now we're saying, okay, we need a better credit borrower because in troubled times, the lower credit borrowers are going to have trouble. They're having trouble without these issues, and that's a reflection of credit score.
So are you saying that now, due to what's going on, nobody that's a 580, 620, can't get pre-approved, or is that specifically just your mortgage company, or is this something that's across the board as of right now?
So it's not across the board every single place. You're going to have people chime in saying, hey, I can still do this. I can still do that. And that is true. If I had to put a percentage, and I haven't researched this, so this is a loose percentage, I'm going to say probably about 70% of all the mortgage companies right now have instituted some form of changes. I've read that some companies have gone as high as 660 and 680, again, to limit risk, limit their exposure. Because if they're holding these mortgages and it's non-saleable on the secondary market, which is a back-end process because payment defaults or forbearance or things of that nature, then they have to own and take the entire loan, which is hundreds of thousands of dollars. So if they've written 10, 15, 20 of these, they may be on the hook for millions of dollars that they don't have liquid funds to be able to cover because of everything that's going on and how fast this hit. So the constraints are being put in place to have a borrower that has cash reserves that are, even if they did lose their job, they're still going to be able to make mortgage payments. We're going to really look at things in a responsible way to lend, to really just make sure that we're doing saleable business to not affect the other mortgages that are out there. What's also going to happen is if other people are writing these mortgages and they default, what's going to happen is premiums are going to be higher with these end investors and services. And what all that means is no matter what the Fed rate is, it means mortgage rates and lendings are going to continue to go up. So that hurts the consumer. It's pushing rates higher, which affects your debt to income ratio because you have a higher rate. Now your payment's higher, it makes your debt to income ratio higher as well.
You don't want them to have a slew of debt on their credit line. That's one. Two, obviously employment is still a current thing because obviously the bank wants to make sure that they can pretty much pay their mortgage. And three, in regards to that, they're not given a higher threshold in terms of percentage wise. So they're looking for more of those individuals that they could take more of a safe risk versus a high risk. And those individuals, they look good if they have a good decent amount of money to put down versus not having a decent amount of money, and the bank basically thinks about this specific buyer before they even try and move forward with the buyer.
100% correct. And think about it this way. If you have, let's say, 100% financing, someone, just bought a house, 100% financing, then they lose their job. God forbid, they're in a bad situation. They can't pay their mortgage. Maybe they took advantage of a 3-month forbearance or forgiveness, but they can't get back on their feet. Now, a bank owns that mortgage eventually. If for some reason they can't get whole again, the bank then takes over that property eventually, if it comes to that. And the bank's stuck with a property that's at 100% plus financed. In fact, if you roll in closing costs, you might be at 105% of the value of your home. And the bank cannot sell that at auction. They're going to take a loss. Now multiply that times, I don't know, however many loans, 100, 1,000 loans across the board. And lenders can't withstand that kind of loss. They can withstand a little bit, to be honest. They have some unsaleable loans. That happens, whether it's a client's misinformation, whether it was an underwriting mistake, but those are few and far between. That might hover between 0 to, let's say, 5%. And now we might be looking at like a 60% clip on something like that. So you can see how devastating that could be to, an industry that basically thrives on loan performance, which helps the secondary market. It helps rates. It helps programs. It helps borrowers get into, homes better. So they will see some restrictions. The idea of some companies that haven't rolled out anything, I've talked to, vice presidents at different companies, CEOs at different companies. If they haven't done it yet, they're certainly discussing it and waiting for the right time. So if you have a file out there, I just impress upon you, if you're below some of these thresholds I'm mentioning, maybe below 640, maybe above 50% debt to income ratio, and you're in process somewhere, you want to talk to your loan originator, that branch manager, whoever your contact is, and you want to ask them if they're affected / are they protected? Are they locked in? Is everything okay? Or do they have any concerns? They want to have clear communication. And that's what I'm just trying to do, is be clear, honest, and transparent with people about that.
Nice. Before we leave off, Doug, I need you to give 3 main things that buyers should do, if they're looking to purchase a house.
So 3 things really quick. Pre-approved, get your credit run, look at that income, pay down or not increase your revolving debt, and then cash reserves. If you can save up or find funds to put down at a minimum level, it's really going to make your process and experience so much better.
Doug, if anybody wants to reach out to you, how can anybody reach out to you, whether they have questions or maybe they're looking to get a pre-approval?
I'm on Facebook. You can find me by my name. You can DM me there. I like to give out my cell all the time. It's 401-499-3684. And just an easier way to remember that, 401-499-DOUG, D-O-U-G. If I can't help you, I can refer you over to somebody that, I know that I would trust as well. But 9 times out of 10, I'm going to get you to the spot where I can help you directly. And I can even help you raise the credit score if needed. I can help you with the qualifications. We can figure out a plan together. So again, 401-499-DOUG. Reach out anytime.
You guys hear that? That's my man, Doug from Envoy Mortgage. You guys know what it is. Whenever you guys whether you guys looking to buy or sell a home, you guys know what to call. I'm that guy. On the next Experiences with Sadiq, catch you guys next week, Tuesday, on Xperiences with Sadiq Live. Talk to you guys soon.